Get my dollar trade playbook to learn how to position, profit, and protect during a dollar devaluation. Scan this QR code or click on the link in the description. This is gold, still forming this wedge, not falling over, not breaking out, also biding its time, very much like that yield curve, right? So yield curve is bear steepening, and we've got gold that's threatening higher. GDX, as you know, already came up to this trend line, pulled back for 1 week, then got above last week. GDXJ has a lot of catching up to do, meaning it has underperformed relative to the majors. So would not be surprised if this is the next one to really, well, it already is. Beautiful. Pullback is shallow. Breakout. Pullback is shallow. We did have one shake and bake, but got firmly back in trend. SIL, I think that's client Jose's silver miner ETF. He's very, very bullish. And you know my silver USD that I published back in June right here said just needs to get and stay above. And it did. It's still in trend. These are the ones that I like. They break out of consolidation and they just kind of hug the 10-week. They pull back, but they don't break the 10-week. So this has, like I said, a lot of room it can go still over time. Add time. Gold is still digesting. GDX is doing fine. GDXJ, honestly, could pick up and run from here, but I am still waiting for this gold miner percent index to hit 100. So let me emphasize this enough. Again, again, and again. This oscillator cannot go above 100. So when I showed this to you last week, and then again yesterday, is this. This yellow indicator can come up into 100, and then it should fall because it cannot get above 100. This does not mean the trend is reversing. No, but it definitely can't get above 100. So remember I showed you last week on the big picture? It can't get above 100, period. It can't get below 0. You get areas where you get signals that are extremely oversold gold. This is how I use this indicator. And then I have an oscillator between 80 and 20. And then we can get into periods where we have a macro thesis and we have a intermarket analysis that says, hey, it's bullish. You can stay in overbought. Overbought's bullish. No question. It can stay in oversold. Oversold is bearish. It can stay there. It's when it has a reversal from overbought or oversold. This was a great head and shoulders formation. That was gorgeous back in November 1st, Fed pause and Yellen Yahtzee. It got above very bullish gold. Very bullish gold. And then it hit, came back a little bit. And then, of course, March, a little oversold. And then the rest was amazing. That's strength. This is overbought. We had some period of indigestion. Do you remember when? Trump. So gold got sold and Bitcoin got bid. So this is just a framework. It's not a timing tool, but it lets me, like this was red and I warned because Trump is the Bitcoin king or whatever. Anyway, the point is gold got sold off, Bitcoin got bid up. And then as soon as it came in very clear what all that meant, we had exact rejection of the gold sell-off and it got bid back up again. And then what happened in April? April 22nd to be exact, gold continuous contract hit 3499 and live, I said that's extended. It wouldn't surprise me if it comes back in. That was April. And this corresponds, where am I? I'm in December. That was a sell-off into Fed. And then we had the gold bid. So April 22nd, it's here. Gold started to weaken, but it's only gone really big picture sideways. But that's what I mean by, okay, then it came back in a little bit and then it got right back above. So this is just a nice little framework here. Nice little framework here. Gold is still bid. And right here, I'm looking for it to catch up to 100, this yellow indicator right here, and then start to form some kind of pattern. We're not there yet, but when it does, that's typically when we have rejection, weakness, however you want to put it, but it's still working. Okay, so this is what I mean by I'm on a weekly view right here. Back in August, I literally said bonds and gold are done going down. At the time, there had been a very, very tight correlation. This is gold crashing into the fateful COVID crash. It was a 5 standard deviation sell-off. Gold, remember, is a collateral. It has collateral damage in risk, especially if it's fast-moving risk, and it was. It screams oversold at certain levels, and we can match it up to macro, etc. But the point is, you can't get above 100. So it stayed up here for a very brief time before gold started to pull back. And again, this was in August of 2020, and bonds, by the way, have crashed and have not recovered for 5 years. 5 years. So they're not anymore tied. They completely decoupled, especially in 2022 when we had central bank coordinated intervention globally. Then again in 2023, Silicon Valley backstop, where White House, Treasury, and Fed said, you get a car and you get a car and you get a car, meaning they were going to backstop all deposits and all banks in the United States. BS. But that's what they said. And we got another backstop, some acronym for bank support, the BTFP. Okay, anyway, move forward to November 1st, 2023. Very important. Fed pause and Yellen Yahtzee. Short duration Treasury issuance to backstop liquidity in plumbing to help the market advance. And we have been hot fire flames since all of these intervention measures. October 2022, 2023, 2023, again, it's just nonstop. Policy intervention. So this is a clue of when it used to be bonds and gold used to trade very similarly. Now they do not. But bonds stopped going up in August. Check it out. Go to TLT. You can see it. They were done. August of 2020 is exactly when I said bonds are done going up and rates bottomed then. So the 100 matters, but it can stay up here for a few months. It can stay down here for a few months. My point is they're just guardrails. But when you see sharp moves like this, it's a buying opportunity. When you see patterns after a while like this and this, it's a buying opportunity. Anyway, my point is now that we're getting into overbought territory, we can stay up here for a little while. Overbought can stay overbought, but it is also a warning that we're getting really extended. And that's all I want to say about that. We can stay up here at 100 for a few months in gold miner bullish percent index, but I definitely would expect a little bit more tussle. Yeah, it triggered 0 in August of 2015. Look at GLD, just for giggles. My indicator, August of 2015, it triggered 0. Am I in the right neck of the woods? That's September. Let's go a little bit here. That's it. It just can't go below that. So it's more of a trend reversal and at extremes, too high, too low. Same thing in August 2020. Remember how I said it hit 100? And I said cannot go higher than 100? And it is exactly here, literally exactly here. August of 2020, it hit 100. August of 2015, it hit 0. These are just oscillators that show you, okay, you can't go below, you can't go above. And look at that nice pullback. Now I know nobody cares on a big picture, but this is very helpful to me to time it. And now we're going into 100 again, but it can stay up here for a while. It doesn't have to be a sharp reversal like the COVID crash when it hit 7. Does it make any sense? I hope it does. Intermarkets for me are just a tool of telling when stuff is overbought or oversold and then trying to time it, and you swim with the current. That's what I want to say. You swim with the current, not against it.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.